Welcome to this explainer. Look, we are officially in uncharted territory. Today, we're breaking down the historic $1.77 trillion SpaceX IPO. We're going to pierce right through that intense market hype and evaluate what this massive liquidity event actually means for retail investors. We've got some fascinating data, eye-opening structural details, and honestly, some incredibly serious questions about corporate governance to unpack. So let's jump right in. Let's start with the ultimate hook, right? A mind-boggling $1.77 trillion valuation. At $135 a share, this is gearing up to be literally the largest initial public offering in human history. To put that scale into perspective, that valuation, it's roughly the GDP of Australia. Yeah, it's a massive liquidity event that bundles their launch services, the Starlink satellite network, and that newly acquired artificial intelligence arm, XAI, all under one giant publicly traded umbrella. But here is what makes this offering truly unprecedented. A massive 30% allocation reserved specifically for everyday retail investors. Usually, retail traders are lucky to scrape together 5 to 10% of an IPO of this magnitude. But brokerages like Fidelity, they've dramatically lowered the barrier to entry. We're talking requiring as little as $2,000 in an account to participate, while early Tesla shareholders are actually getting priority access. This whole setup has ignited intense FOMO across the market, basically fulfilling Elon Musk's years-old promise to give retail loyalists a real seat at the table. But, as NYU's Dean of Valuation, Aswath Damodaran, rightly points out, you really have to stop and ask yourself a fundamental question here. Are you buying a fundamentally sound, mature company? Or are you just making a highly loaded bet on one man? Damodaran suggests that while momentum traders are absolutely going to drive this stock to the moon on day one, the underlying fundamentals, well, they tell a much more complicated story. Okay, so let's move past the hype and look under the hood at the actual financial realities. When you actually break down the business model, you uncover what analysts are calling a Trojan horse. As a prospective public investor, sure, you're buying into the highly profitable Starlink connectivity business. I mean, it generated $11.4 billion in revenue with a fantastic $4.4 billion operating profit. But here's the catch. Starlink is actively subsidizing massive cash burns everywhere else. The launch segment, specifically Starship development, is just eating up $3 billion in R&D. And that newly acquired XAI segment, it is burning massive amounts of capital on compute infrastructure. So when you tally all of that up, the math is genuinely sobering. Despite pulling in a massive $18.67 billion in total revenue for fiscal year 2025, SpaceX actually posted a staggering $4.94 billion net loss. Let that sink in. You effectively have a highly profitable internet provider acting as the sole financial engine for incredibly capital-intensive, loss-making bets on multiplanetary rockets and AI data centers. And that leads us to a pretty stark valuation reality. Retail investors buying in at this IPO price are paying an estimated 94 times price-to-sales multiple. 94 times. For comparison, think about NVIDIA. Arguably the most sought-after tech giant in the world, operating with around a 60% net profit margin, right? They trade at roughly a 30 to 35 times multiple. So you're paying nearly triple the premium of the most expensive tech giant on the market for a company that is currently operating at a multi-billion-dollar loss. Which brings us to the absolute most critical part of this explainer, corporate governance, and the fine print that every single retail investor needs to read. This IPO exposes a massive illusion of control. When you buy shares, you're getting Class A shares, which grant 1 vote per share. Simple enough, right? But the company holds Class B super voting shares that are shielded entirely from the public. Because of this dual-class structure, Musk retains roughly 85% of the total voting power. That essentially renders your Class A shares completely powerless when it comes to any matters that shareholders typically decide, including board elections. According to a really sharp critical analysis by Harvard Law School scholars Lucian Bebchuk and Kobe Castile, this structure is explicitly designed to eliminate traditional board constraints. It's not a bug, it's a meticulously engineered feature. Even if you completely believe in the founder's vision, loosening constraints on power to this extreme degree poses a massive structural risk. And the immediate risks to your investment here are very real. Because of SpaceX's incorporation in Texas and its explicit charter provisions, the CEO is legally permitted to redirect lucrative business opportunities away from SpaceX right into his own hands. He has the ability to arrange related party transactions that could benefit himself over public investors. Plus, there are absolutely zero requirements for him to limit his outside time. That leaves him completely free to focus on X, Doge, or whatever else catches his eye, despite wielding massive influence over your investment. And these aren't just short-term issues. Those risks are baked in for the long haul. This absolute control is deeply hardwired right into the corporate charter. If Musk were to step down or become incapacitated, control doesn't just naturally revert to the board. No, it passes to unnamed heirs or trusts. And perhaps most alarming for your equity value, this small minority controller structure allows the founder to sell off massive fractions of his own equity to generate personal wealth, without ever losing his iron grip on the board's voting power. It's gotten to the point where major institutional investors are actively sounding the alarm. Major pension funds in places like California and New York have loudly protested, stating this IPO structure makes the CEO essentially unfireable without his own consent. They're arguing, quite forcefully, that it leaves public owners completely lacking in fundamental corporate protections. So, how exactly is Wall Street reacting to all of this? Let's look at market mechanics and the index dilemma. We are currently witnessing a massive clash in market mechanics. Just to accommodate a giant like SpaceX, NASDAQ fast-tracked their rules, allowing them inclusion in their major indices in a mere 15 days. But on the exact opposite side of the spectrum, the S&P 500 is completely blocking SpaceX. S&P Dow Jones indices refuse to bend their rules. They demand that constituents generate actual positive GAAP earnings in trailing quarters. And honestly, that's just a hurdle SpaceX cannot clear right now. Now, why does this matter to you? It's all about passive capital. NASDAQ's inclusion means roughly $600 billion in passive capital that tracks the NASDAQ 100 will be mechanically forced to buy SpaceX stock, totally regardless of its profitability or its governance risks. Now, sure, this influx will likely prop up the stock price in the short term and create intense volatility, but you have to remember, those severe structural governance issues we just walked through, they remain entirely unresolved. Let's bring it all together now. Are you just a passenger? Let's get to the final verdict. To summarize the reality we've explored today, investors are paying an historic $1.77 trillion premium to buy into a conglomerate where the profitable parts are subsidizing massive $4.9 billion losses. And most critically, your shares grant you absolutely zero influence over severe corporate governance risks. It leaves you entirely beholden to the decisions, the outside interests, and the absolute control of a single individual. So here is the absolutely critical question you need to ask yourself before buying into this unprecedented hype. At $135 a share, with virtually no voting power and severe structural risks lying ahead, are you actually buying a seat at the table, or are you just paying for the ride? Thank you so much for tuning into this explainer. Keep doing your research, always read the fine print, and we'll see you next time.